What if everything you thought you knew about portfolio management was incomplete? This isn't just another theory or some high-frequency buzzword soup. It's an AI model that doesn't just crunch numbers. It senses the market's moods, and it's doing something even seasoned quants didn't think was possible. Forget black box predictions. This one actually explains its decisions. It adapts in real time. It knows when to go full throttle and when to hit the brakes. And here's the kicker. Backtests show it outperforms traditional strategies by more than double, with less than a third of the drawdown. If you're serious about investing, if you want to know what's coming before it hits the headlines, you need to hear this. Stick around. What you're about to hear might just change the way you manage risk, seize opportunity, and understand the market itself.
What if you could peer into the financial markets, not just as this, sea of endless numbers, but see it more like a living, breathing thing?
Yeah, with its own distinct moods, its own cycles, some of which can be pretty surprising.
Exactly. And then imagine using that kind of, almost uncanny insight to make dramatically smarter investment decisions.
Right.
I mean, for anyone trying to navigate the complexities of financial markets, the quest for that edge, that deeper understanding that really sets you apart, it's constant, isn't it?
It really is. You're always searching for the next breakthrough, that moment of clarity.
And that's precisely the territory we're exploring today.
Yeah, it's about moving beyond just reacting to the day's headlines, isn't it? It's about truly trying to anticipate market shifts, seeing the underlying currents before they become big waves.
That quest for an unparalleled edge, that's exactly what we're going to try and unravel in this deep dive.
Absolutely.
Today, we're taking a deep dive into, a really groundbreaking approach. It's not just about tweaking how you divide your money, asset allocation, but it's fundamentally changing how we understand market dynamics at their very core.
We're talking about a convergence, really. Sophisticated data analysis, AI, artificial intelligence, and something traditional models often miss.
Which is?
Those very real, sometimes emotional shifts in market sentiment.
Okay. So our mission here is to unpack how this new explainable AI model.
Yeah.
And that word explainable is a key, right?
Absolutely key. How it's not only outperforming established strategies, and by quite a wide margin,
right,
but also offering this unprecedented clarity into why the market is behaving the way it is.
It's a fresh perspective then. A new lens to really see what drives investment success, something that gives you an understanding others, they just won't have.
Exactly. Get ready to discover what might just become your new favorite way to look at the market.
So for decades, investors have kind of been using these market maps that, maybe in hindsight, were a bit like trying to navigate a bustling city with a dusty old street plan.
Yeah, that's a good analogy.
We often talked about asset allocation, how you divide your money between stocks, bonds, commodities. It's the cornerstone, really.
The absolute foundation.
And historically, the pioneers, people like Markowitz, they introduced these revolutionary concepts, like the mean variance model.
Which was a huge leap forward, moving from simple rules like the old 60-40 split,
right,
to something much more quantitative, data-driven, trying to actually optimize risk and return.
And that quantitative approach, it kept evolving, didn't it?
It did. The Markowitz model, brilliant as it was, had its limits, especially sensitivity to small errors in estimating returns, which is hard.
Very hard.
So that's where the Black-Litterman model came in. It was a significant evolution.
Oh, so?
Because it incorporated this idea of market equilibrium, basically, that current market prices already reflect a kind of consensus view. And crucially, it allowed investors to blend in their own subjective views, their hunches, their unique insights.
So it made it more flexible.
Much more flexible, much more practical for, real-world portfolio management.
Okay, so if these models like Black-Litterman were so advanced, why are we still talking about needing something new? What went wrong? Where did those old maps still fail us?
Well, despite these advancements, a critical flaw remained, especially in certain market conditions.
You mean when things get choppy?
Exactly.
Yeah.
When stock markets become highly volatile, and we're talking volatility that can really spike, maybe 40% annualized for stocks, while bonds might be chugging along at less than 1%.
Wow, big difference.
Huge. And in those scenarios, traditional models, even Black-Litterman sometimes, they often became overly cautious, almost. timid.
Timid, okay. How did that play out?
Well, they tended to heavily concentrate portfolios in the safer, lower-returning assets, like bonds.
Which sounds sensible on the surface, right? Safety first.
It does sound prudent, but the effect was you were missing out on potentially significant opportunities in stocks. It wasn't really about avoiding recklessness. It was about the models just not being able to dynamically adapt.
So they couldn't see the opportunity within the volatility.
Precisely. They were too constrained by their risk-averse programming during those volatile periods. They essentially pulled back right when maybe, just maybe, a well-informed, nimble investor might see a chance to lean in.
That's the missed opportunity.
Yeah.
The frustration.
That's exactly where it lay. And that's where AI comes in with a completely new vision.
Right. Forget those old, rigid frameworks. This research we're diving into, it uses an AI technique, hierarchical clustering.
That's the one. It uses it to divide the whole economic landscape into 4 distinct regimes, or moods, as you called them earlier.
But here's where it gets really interesting, you said. It's not just about the usual economic indicators.
No, this is the critical shift. Think of hierarchical clustering like a really sophisticated sorting machine for data. It doesn't just use predefined buckets. It systematically looks for the natural ways market data points group together. It reveals these hidden regimes the market is truly in, almost like finding the market's unique DNA at a particular moment.
And the data it uses is richer.
Much richer. Yes, it includes the standard macro stuff, inflation, CPI, PPI, growth indicators like industrial output, PMI, money supply, interest rates. All that's in there. But it layers in something absolutely crucial: short-term market technical indicators.
Okay, that sounds fascinating. Not just the big picture, but the real-time signals. What are those specific technicals? I bet you're eager to know how this gets so granular.
I am, yeah. So the model uses things like 15-day momentum and the 12-day relative strength index, the RSI.
Okay, standard enough tools.
Yes. But here's the nuance, the detail that makes it powerful. It doesn't just use the raw values. It uses the difference between their maximum and minimum monthly values.
Oh. Why that difference?
Because that helps capture market volatility, the swing, and more importantly, it taps into investor sentiment, those underlying currents of, optimism or fear.
Sentiment. Okay, that's the explainable difference you mentioned earlier, isn't it?
Exactly.
Because unlike some AI models that are just a black box spitting out answers.
Right, with no why.
This one combines the macro data with these real-time sentiment indicators. So it interprets regimes not just by cold, hard numbers, but also by, what do the researchers call them? Investors' mood swings.
That's the phrase they use. It's like it's actually feeling the market's pulse, which is a game changer because human emotion, well, that's often the biggest driver of market extremes, isn't it?
It absolutely is.
Yep.
So it can adapt in real time.
Yes, it adjusts its classification standards dynamically, reflecting that recent market sentiment. It moves beyond static economic definitions to a truly dynamic understanding of market psychology.
Pinpointing those moments of irrational exuberance or undue panic.
Precisely those moments. Things traditional models might smooth over or miss entirely.
And is there proof this actually works? Does it pick up things others miss?
There's compelling proof in the patterns it found. The research highlights this fascinating detail. The method uniquely identified what it called the abnormally large wave in the stock market from 2015 to 2016.
I remember that period. Very distinct.
Very. And it tagged it as its own unusual regime. Traditional methods, they just couldn't pinpoint that unique market period with the same clarity.
Wow. Imagine being able to recognize those specific outlier phases that others miss. That's a real edge.
An unprecedented level of understanding.
So what does that mean for how different assets behave when the market shifts into one of these AI-identified moods?
It's incredibly insightful. The model clearly shows how different assets perform across these regimes. Stocks, for instance, they show the biggest changes in returns depending on the regime. No surprise there, maybe.
Right.
But we also see things like commodities and gold often having strong negative correlations with stocks in specific regimes.
So acting as diversifiers just when you need them.
Exactly. Crucial diversifiers. And even bonds, they show distinct behaviors, too. Sometimes performing poorly when stocks are roaring, other times becoming absolutely essential safe havens during stock market downturns.
So it really understands it's not a one-size-fits-all market.
Absolutely. It gets that and adjusts accordingly.
Okay, so we have this new AI-powered lens. We can categorize market regimes with unprecedented clarity using the refined Black-Litterman model. You'd think the puzzle was solved.
Almost. But there was still this nagging piece, this unsolved challenge.
Which was?
How do you actually capture even higher returns from the riskier stuff like stocks without constantly exposing the portfolio to, well, excessive drawdowns, big losses?
Right, to balancing act.
Exactly. People had tried things before, like setting strict weight ranges on assets or adding complex mathematical constraints called regularization.
But they didn't quite track it.
They didn't quite hit the mark. They couldn't truly unlock the full potential of these regime insights.
So what was the breakthrough?
This is where the real ingenuity shines. The final crucial component. They call it the rotation of objective functions.
Rotation of objective functions, okay.
It sounds complex, but it's described as a simple timing strategy. Essentially, it dynamically adjusts the goal of the Black-Litterman optimization.
Adjusts the goal.
Yeah, think of it like driving a high-performance car. You need to know when to shift gears, right?
Sure. Sometimes you accelerate hard, other times you prioritize control.
Precisely. Traditional models were often stuck in one gear, maybe maximize safety or maximize risk-adjusted return, regardless of the road conditions. This new approach knows how to shift.
Wow, okay, so that rotation of objective functions is the secret sauce. How does that dynamic switch actually work? What triggers the gear shift?
It's quite precise based on specific market data.
Yeah.
When the stock market's annualized volatility, remember, the size of its swings.
Measured over 30 days for major indexes.
That's right. When that volatility exceeds 20%, that's condition 1.
Okay. High volatility.
And condition 2, there's a clear upward breakthrough trend, which they define as the current stock price being higher than the average of the previous 10 days.
Got it. High volatility plus a clear upward move.
At that exact point, when both conditions are met, the model shifts its objective.
From what to what?
Instead of just, say, maximizing the Sharpe ratio or minimizing variance, it strategically switches its goal to seeking maximum return while keeping its overall risk level fixed at that 20% volatility threshold.
That's fascinating. So it's not just reacting, it's almost proactively strategizing. It decides, okay, conditions are right, let's go for gains, but within this controlled risk budget.
You've got it. This dynamic switch allows the model to significantly increase its holdings in stocks precisely during those opportune moments.
Leading to those excess returns you mentioned.
Exactly. Substantial excess returns. It's like having that expert co-pilot who knows exactly when to hit the accelerator to ride an uptrend, but only when the conditions are just right.
And then presumably it shifts back when conditions change.
Precisely. It reverts to a more balanced, risk-aware approach, maybe back to maximizing Sharpe or minimizing variance, when that high volatility isn't accompanied by a clear upward trend or when the trend breaks down. It knows when the risk isn't justified.
And you mentioned they tested other complex machine learning methods?
They did, things like support vector machines, SVM, and LSTMs, trying to predict returns directly.
But they didn't work as well.
Didn't yield significant improvements over this specific combination of clustering and the objective function rotation. It really highlights the power and maybe the elegance of this particular solution.
Okay, elegance is nice, but let's talk brass tacks. Performance, the numbers. In finance, that's what speaks loudest, right?
Absolutely. And these numbers are truly compelling.
They backtested it rigorously, you said.
Yeah.
August 2010 to May 2020. Compared against benchmarks.
Yes, a solid decade of data. And the results, well, they're more than compelling. They're pretty exceptional.
Okay, break it down for us. How did the simple strategies do?
Right. An equal-weighted portfolio, just dividing money equally, gave a cumulative return of about 21.5% over that whole period.
Baseline.
A traditional Black-Litterman model, set to maximize its Sharpe ratio, risk-adjusted return, did better. Around 56.3% cumulative. Safer, but relatively slow growth.
What about going for broke? Max return focus.
Yeah, they tested a Black-Litterman model aiming for maximum return, but with a higher fixed risk level, 30%.
Huh?
That delivered about 137.5% cumulative.
Much better returns. But the catch.
The catch was high volatility and some severe occasional losses along the way. Not for the faint of heart.
Right, and the rotation model, the one we've just unpacked.
Yeah.
The AI-powered mood-reading objective shifting one.
Get ready for this. The rotation model delivered a staggering 213.5% cumulative return over the exact same period.
Wow, okay, that's a huge difference.
It's a significant leap, more than doubling the returns of even that higher-risk traditional model, and a nearly 4 times the Sharpe-focused one.
Those cumulative numbers are impressive, but let's make them pop. Key performance indicators: annual return, Sharpe ratio, alpha, and, crucially, drawdown.
Let's do it. Annual return for this rotation model, an impressive 22.53%.
Compared to?
Compared to the Mag Sharp model's 5.94% or the equal weight's meager 2.27%.
Okay, big difference on return. Sharp ratio. Risk-adjusted performance.
A very solid 1.06, which indicates excellent performance for the amount of risk taken, much better than the others.
And alpha, that measure of manager skill, or in this case, model intelligence.
The highest among all models tested, a remarkable 0.20.
So 0.20 alpha means?
It means, roughly speaking, the model generated about 20% in extra annual return purely from its intelligent decisions, beyond what you'd expect just from its risk level or market movements. Pure skill, essentially.
Okay, that's genuinely impressive. But the killer question for many investors, the downside, maximum drawdown, the biggest loss it experienced.
This is crucial. Its maximum drawdown was constrained to just 8.26%.
Only 8.26% compared to the high return models.
Compared to that model's painful 31.72% drawdown.
Right. So you're getting significantly higher returns with significantly lower peak to trough losses.
That's the remarkable balance it achieved. High returns with truly controlled risk.
So putting that in plain English.
Yeah.
This isn't just outperforming by a bit, it's practically in a different league.
It really suggests a different level of performance potential.
Double the returns of even a strong traditional strategy while drastically cutting down those stomach-churning losses. The takeaway seems crystal clear.
Yeah, this AI-driven rotation model demonstrates remarkable robustness, as the researchers put it. It excels at quickly identifying those profitable signals to get into the market.
But just as importantly,
it knows when to get out, or at least reduce risk before a potential plunge, dynamically shifting to safer assets.
it really responds to market fluctuations intelligently, in time.
It does. It's not just static prediction. It's dynamic, intelligent response to changing conditions and sentiment. It's about truly understanding the pulse of the market.
So what we've seen today really is this powerful demonstration of how explainable AI, by integrating that deep macroeconomic insight with the subtle, often emotional shifts of market sentiment.
Yeah, the mood swings.
It can create a truly superior asset allocation strategy. It's not just about crunching numbers to predict what might happen next week. It's about understanding the underlying reasons, the why behind the what's.
Exactly. This approach gives a level of clarity and, frankly, control that traditional models just couldn't provide. And it leads to measurably better results while managing risk far more effectively. It feels like a new benchmark.
So as you, our listener, think about navigating your own financial future, what does this new era of explainable AI in finance really mean for you?
It's a big question.
It is. If an AI can accurately interpret the market's moods, dynamically shift strategies like this, and consistently deliver superior risk-aware returns, how might that fundamentally reshape the way you think about your investment decision?
Or your portfolio management, or even just your own financial planning.
Right. In a world that's clearly being increasingly driven by these intelligent systems, it feels like more than just a new tool.
It's like a new lens, maybe?
A new lens, offering both unparalleled clarity and, well, a really compelling case for rethinking your entire investment playbook, something to really mull over.
If you've made it this far, you now see the market through a different lens. Not just numbers, but moods, patterns, and signals that most models still ignore. This is just the beginning. The future of investing isn't about reacting, it's about understanding. And we're here to decode it, one deep dive at a time. So if you found this valuable, help us spread the signal. Like the episode, share it with someone who needs a smarter edge, and make sure to subscribe to the channel so you never miss what's coming next. Liked how that paper got decoded? We've spent 20+ years turning machine learning and AI into real-world tools, not just slide decks. Whether you want to implement a model, validate research, or build something from scratch, we can help. Explore our showcases to see it in action. Visit our site or contact us directly. Let's turn complex ideas into working intelligence together.